Well, greetings, students. We are going to review just a little bit of what we covered last week. You talked about, or you read about, our introduction to the relationship of budgeting in the planning process. So what we talked about is there are 8 steps to pre-planning for your budget. We know that you can't just have a budget and say, I'm going to spend money this way. You have to plan for how you're going to spend money for your organization, your nonprofit organization. But there also is this rule that it takes money to make money, right? And so those 8 steps for pre-planning and adopting a balanced budget are going to be really very important. Different types, you also talked about last week, or you read about different types of planning approaches, including the top-down theory, where that means those in administration make all of the decisions and then they tell everybody that works under them, this is what you're going to do. The bottom up, which is where the workers, those that we call the worker bees, get to have input on what they'd like to do, the goals for the organization and the programs, and then they move that up to the administration and say, we need you to fund it. And then there's that goal down, plant up process where administration may give the working crew or the staff and faculty the plan or the goals for the organization, but then those who work in the organization's programs get to determine how they're going to implement those goals in their program. You also found out that that is probably the most equitable way to get workers in a nonprofit organization to work together and to have buy-in to the overall mission and goals and objectives of the organization. Then there are different types of budgets. We talked about the line item budget. We talked about the program budget. We talked about the functional budget, and another term for functional budget is the performance budgets, and they all serve a different purpose. Line item is when you may have a program, but you need to turn into your supervisor the cost that it's going to take for you to run your program. That's a line item budget where you put expenses, revenue, assets. And then you have the program budget, which may be for the entire program and several different projects within the program. The functional budget is the overall kind of operating budget, and that is how are all of these programs going to work together. We need to fund the personnel, we need to fund the activities, we need to fund the projects, we need the supplies, and we also need to make sure that everybody has benefits and all. That's the functional or performance budget. So that's the last week. So here we are, this week's discussion. And you have chapter 4 to read on budgeting. And you also should probably start Weikert's text on chapter 2 on budgeting and the planning process altogether. Some of that information will overlap, but it will give you a more in-depth understanding of the budgeting process in the nonprofit sector. So let's begin. So this week you're going to learn about the components of an agency's budget, right? Which is generally going to be the line item budget that feeds into the program budget. Factors in expenses and revenue, the difference between expenses and revenue, and ways of allocating costs within your organization's programs, okay? So functions of a budget. We know that a budget it's another way for you to communicate to your funders how you are going to meet the mission of the organization. The budget is the funding way, or the monetary way of explaining how an organization is going to work to meet its mission and vision and goals. So it's connecting the mission to the funds. It's clarifying the goals of the organization. The budget also brings about coordination of activities. If it's not funded, you can't do it. You may have brainchild and great ideas about, oh, we could do this and we could do that. But if you don't have the funding for it, it's not likely that your program or project is going to be able to move forward. It communicates your objectives, those working tasks, those inputs, throughputs, and outputs, which you've learned from chapters 1 and 2. It puts the funding to those inputs, those throughputs, and those outputs. And then it sets some control. We talked earlier about the importance of it takes money to make money, but once you get the money, you have to be accountable for those funds that you get in. You can't just spend funds. Let's say it's kind of like your financial aid. You get the loan, you pay for school, and some of you go shopping. And I understand the need to go shopping, but there will come a point where you'll have to pay that back, or you'll have to be accountable with how that money is spent. And if you went shopping for a new pair of kicks, Converse, tennis shoes, and you didn't buy your books, ultimately it's going to cost. And it's the same thing with a nonprofit organization. If an organization raises the funds and says they're going to use it to provide funding for an after-school project for kids, and they end up buying a new van with it, they're not being accountable for the funds. So that's what a budget does. It lets your donors know, it lets your stakeholders know, it lets your staff, your workers, and your constituents know how you are going to work to meet the mission. So there are two types of budgets. You've got the operating budget, or the master budget, right? And you have the capital budget. The operating budget is going to be used for you to implement all of the programs and projects you want to get done. And it's good for the fiscal year, FISCAL, not physical, but fiscal. That means the year where the funds are allotted to be spent. Generally, it's from July to June, or it may be from September to July. That's a fiscal year. It doesn't go from January to December. And during that time, you have 3 quarters every 3 months. You generally have to write some type of report of how you spent the funds that were allotted for your project. Okay. Myers on page 65 gives you the components of an operating budget. You need to know that. Okay. Then we talk about the capital budget. The capital budget is used to plan and purchase items for your organization, large items. You need to plan for that next building. If you're grown out of your current facility and you want to buy a new building, you can't just go buy the new building because you have in your savings account $1 million. You have to allot how to make the money work for that building. That $1 million may be an endowment. You're going to learn that term later, which means you can't touch it because you're only going to use the interest to help run the organization as unrestricted or open funds. So remember that your capital budget is used to plan for how you're going to purchase, lease or renovate large assets, such as buying or renovating a building, buying a van. There are types of budgets that we're going to talk about. Myers on page 65 talks about the different types of budgets and gives you about 5 or 6 cash flow budgets, zero-based budgets. And so we're going to talk about the expense budget, the revenue budget. We're going to talk about those, okay? Okay, so let's talk about those different types of budgets. We talked about Myers, page 65 and on. I'm not going to break those down because you're going to have a project where you're actually going to be developing a budget, a line item budget. But I am going to present to you some key terms that I think you really need to pay attention to as you read. So let's talk about the expense budget. Or the revenue first. You want to know about the money coming in, right? So the revenue budget lets you know, it's the way to find out where your money is coming from. In chapter 3, we talked about the different sources. You need to diversify the sources of your income, whether it's grant, whether it's government funding, whether it's stakeholders and independent individuals who are philanthropists and want to give millions of dollars to your after school project, or whether you actually did a campaign and you did a fundraising event, such as a golf tournament or silent auction. Okay, you have to budget those funds. You have to allocate for those funds and say where those funds came from. Then you have to budget what portions of those funds are going to go to different aspects of your projects. So be sure to read about revenue budgets. And then we talk about expense budgets. Your text talks a lot about expense budgets because it's not enough just to get the money. Now you have to be accountable to where the money goes. And one of the things that's very important for funders, know this, funders will pay attention to where your expenditures are. And they are not really happy when the majority of your expenditures goes to administration or personnel. Most funders want you to spend the majority, 80% of the monies that you get in from them, if not more, towards the actual project. Get those children in the after school projects, get them books, get them snacks, get them toys, take them on trips. That's what some major funders want you to spend your money on. So you have to be very careful with how you, in your diversifying your resources, how you have allocated the funds. You want to pay attention to what your donors say they expect from you. If you're writing a grant and you're trying to get a proposal together, you want to read the details because it'll be important how you allocate those expenses. So the expenses reflect how the money will be used within the organization and the various units where it will go. Let's talk about that term. Well, before I go to talking about the term units, let's talk about the different types of expenses. And I'm going to try to bring it home to you. So you have variable expenses. Those expenses are very direct in the sense that they are related to volume. So a good example of a variable expense would be the gasoline in the company van. You know, the more gasoline you use per unit, right, the bigger the expense. You can try to budget for gasoline, but sometimes you may have a trip that takes you 300 miles and you have to allocate for that trip, and it's called per diem. You have to allocate for those mileages. A fixed expense is an expense that doesn't move from month to month. It doesn't change. Can you think of one? I'll give you a couple of minutes. Think of something that you have to pay, a bill you have to pay, and the amount never changes. You're right. Rent, house payment, your car note. Once they're set and you've made the agreement to pay over so many months, that amount doesn't change. That is a fixed expense. And then you have the mixed or semi-variable expenses. Those are those bills or expenses that are both fixed and they vary from time to time. So for instance, you may have, let's say you prepaid on your telephone. Right? Cell phone. You got a prepaid cell phone for your program coordinators when they're out in the field. So you've already allotted $50 a month for texting, unlimited texting, and unlimited calls. But let's say they got carried away and they actually talked more and texted more than you had paid for. Well, the company's not going to stop allowing them to use it. What they're going to do is just start to bill them for that additional time. Well, that's called a fixed rate because you paid one cost, but it's variable because maybe they went over the limit and now it's gone up by volume. So that's semi-variable. Remember that. I may give you a pop quiz. Okay. So now let's move to talking about unit costs. Some other terms. Unit cost is the mathematical way of seeing it is a unit cost is equal to the total amount of cost divided by the units of service. So if you are a counselor, let's say you're a human service worker and you're doing counseling and you see students for an hour. Well, every 15 minutes may represent 1 unit. So if you're seeing a student for an hour, that means you've seen them for 4 units, right? And if the insurance pays the organization back $10 per unit, and you've seen a young person for an hour, that means they're going to get approximately $40 for that hour. If you see several students in a group, then they can bill that way. So that's unit of cost. The total program cost divided by the number of units of service. That's going to be really important when you start to work on your Sojourner Truth program budget. Okay. Some other terms before we end. We're just about done. Terms I want you to remember. Remember, expenses are the funds, the number of money or the amount of money going out of an organization due to various costs. Revenue is the amount of money coming in based on your sources of income, various sources of income. Your net assets is the amount of money left over in revenue after you've paid all of your expenses. Okay? So, in the for-profit or in the corporate world, we would call net assets what? You got it, profit. But we all know that in the nonprofit sector, you can't have profit without putting it back into the organization. So we call those net asset. That's the amount that you can add to the next month as you start to build your budget for the next month's expenses. Okay? Well, this should have gotten you started, gotten your little brain juices going. You should be able to now start to comprehend and pull together the information you're going to be reading. And now you should start pulling this all together one step at a time. I think there's 7 steps to the activity, the Sojourner Truth budget development. And these terms and concepts we've talked about today should help get you started. Have a great week.